Hi everyone, thank you for your time today. I'll be presenting on the MIGO Opportunities Trust. And it's been a really interesting time for investment trusts. So hopefully by the end of this presentation, you'll be feeling quite reassured and optimistic about what's coming down the pipeline in the sector. First to start off, this is the team and this is what the trust does. What we're looking for are discount opportunities in the investment trust world. And as you can imagine, it's been a rather opportunistic time at the moment. We've got an incredibly diversified portfolio. We can invest in anything as long as it's held in a closed-ended structure. That means we have lots of different asset classes and we invest all across the world. And this trust was actually launched in 2004, so this year is our 20th anniversary. My colleague Nick Greenwood launched it 20 years ago. So we've got a long track record and lots of experience in this area. One of the big changes for the trust is that we have moved to asset value investors. So at the end of last year, MIGO, the open-ended, myself and Nick landed at asset value investors. And we're absolutely delighted. It gives us more resources. We are now in a investment trust specialist house, so we're very pleased with the move. So to put some context, and I'm afraid that this presentation starts on a little bit of a down note, but the last 18 months has been, very tough for markets in general, and particularly in the investment trust sector. And there's, two real reasons for this. First of all, you've got the sort of macro market backdrop. You've had rising inflation, rising interest rates, and this has undermined a lot of asset prices. First of all, in the markets in general, but particularly in investment trusts, where you've got a lot of alternative income strategies, for example, and those trusts specializing in earlier stage private equity companies as well. And this has meant that investors have moved away from the sector. The second part of it is the problems for the OCF, which I'm sure many of you will have experienced. And the issue here is that investment trusts, because of these sort of synthetic costs that they're asked to disclose, have meant that the trusts look very expensive in comparison to open-ended funds, which has meant even investors who really like trusts have been sitting on the sidelines more and not increasing their exposure just because of these cost issues. We've also had a continuation of the consolidation theme in the wealth management sector. This has been growing for many, many years now, but we saw Rathbones and Investec as the latest sort of large merger. This means that the wealth managers have been less able to invest investment trusts, especially further down the market cap spectrum. And this has all resulted in discounts widening out considerably, some underperformance of trusts, and investors kind of leaving the sector. So to put this in some context, this is a graph from the 1990s, just showing how wide discounts have got to in comparison to sort of historical averages. And the last time we saw discounts this wide was in 2008. Even during COVID and that dislocation of the market, discounts hadn't blown out quite as wide as they have been in the last 18 months. We've seen a bit of recovery, but still in historical averages, there are an awful lot of discount opportunities. So when you're running a trust like MIGO, it's been a difficult period in that investment trusts have had a tough time, but it has also created an awful lot of opportunities for us because we are looking for those discount opportunities. We are looking for times where we can buy really good assets for a fraction of the portfolio's price. And just to add some colour for our own portfolio, this is our top 10 as at the end of March, and you can see that average discount is touching nearly 36%, and this is far wider than we saw in COVID. This is kind of the closest that we've seen this would be the GFC in 2008. And lots of these trusts, there's nothing going wrong at the portfolio level. It's just that the share prices have been languishing on a very wide discount. So what do we do kind of looking forward? Obviously, this is all a bit dour, this is all a bit down, but what happens when discounts get this wide is that once there's a bit of normalization, because of whether it's normalization of interest rates, whether it's OCF issues being resolved, it does mean that the recovery can be quite spectacular. And so these are just two illustrative graphs of kind of what myself and Nick are looking for and why we think that buying investment trusts on deep discounts is such an exciting mandate. Because if you buy, and you can see it on the graph on the left, if you buy something at NAV and it goes up 20%, that's fabulous. That's absolutely wonderful. That's a great return for your investors. But if you buy something at a 35 discount, as we saw in the previous slide, which is our average discount at the moment, and what you get is some NAV performance, that same 20% NAV performance, but you also get that discount narrowing. It means that that combination of returns can be quite explosive. And then on the right-hand side, realization is also an opportunity to extract value from these discount opportunities. And what we've done here is we've said that actually let's say that there's a slightly disappointing NAV return for this invented trust. Say that in order to realize the assets, you've had to take a 10% haircut. Actually, if you bought the trust at a 35 discount, still, if you get the realized assets at a 10% discount from the original price, that still is a fairly decent return. So these are just two examples of how we think that we can extract value from the current portfolio. Obviously, those graphs are nice and illustrative and invented on Excel. So to put this into a bit of context and to give you some real life examples, something we have in the portfolio where we've seen some of this movement, some of this discount narrowing and NAV improvement is Schiehallion. This is a Baillie Gifford trust that invests in sort of private equity, but sort of the late stage of early stage companies. And this trust fell to an incredibly large discount last year. Rising interest rates meant that investors felt quite nervous about the valuations of the underlying portfolio. It was an area that was hit particularly hard in the sell-off, and therefore, it fell to an incredibly large discount. And what we've seen since is a good recovery. You've seen that NAV appreciating, and we bought this in November last year. You've seen a bit of NAV appreciation, but you've also seen some of that discount narrowing. And as you can see, actually, the returns because of that discount narrowing with some NAV appreciation have been very nice. And on the realization side, real estate investors is something that we have in our top 10. And this is a trust that has struggled to gain traction with investors over the last sort of 3 to 5 years. The trust was quite small. It was a Midland specialist, but investors were looking for pure play, either offices or logistics or home or residential. And instead, real estate investors had a sort of a combination of these assets. And so they struggled to gain traction, and the portfolio has now moved into liquidation. The current NAV stands at nearly 55p. The share price at the end of March was 33p, which represents a 40% discount to net asset value. And let's take the illustrative example that we looked at earlier. Say the costs of realizing the portfolio means that we will lose 10%. Even at that point, we will still get a 33% return. The portfolio is currently yielding nearly 7.5%. So we would also describe this as we're being paid to wait. So we've talked a bit about the context of what's been going on, and we've drilled down into some of the specific opportunities, but it's interesting to look at how different the portfolio looks since about 18 months ago. So this 2022 graph is taken from our interims in October, and then this is the most recent graph of our exposure on the right-hand side. And I do appreciate that this slide is very busy, so I have highlighted in green the areas that I'll be kind of focusing on. And the biggest and most obvious one that you can see right from the start is the change in the cash position. In 2022, we felt that markets had got quite frothy in 2021, and we've been raising cash. We were around 15% cash, 15% cash. Fast forward to 2024, and we are moderately geared, about 2.5%. And we've just been recycling this money into lots of different opportunities, but in particularly in two sectors, in two areas. You can see with this dark blue segment, in 2022 it was very, very small. This is the alternatives sector. This is alternatives, and that has grown substantially into 2024. And lots of these trusts, whether it's in renewable energy, whether it's alternative lenders, leasing, lots of these areas have been undermined by rising interest rates. And they were vehicles that were constructed to provide income to investors when yields were incredibly low. And investors have moved on, or lots of investors have moved on to other areas to get their income while interest rates have gone up. But actually, there's really nothing going wrong in these portfolios. And these discount opportunities have been incredibly attractive. Equally, in the private equity area, what we've increased in Schiehallion, our previous example is a good example of this. Schiehallion is one of the sort of earlier stage or perceived earlier stage investment trust, private equity investment trusts. So others that we've added to would be Augmentum, Chrysalis, and Seraphim Space. And what we're looking for here is what we would describe as an arbitrage between perception and reality. So the perception of these trusts is they have lots of early stage, lots of very risky companies, but actually the reality is that lots of their underlying portfolios are either profitable or have decent cash runways into profitability. And so this fact has been misunderstood by the market, and therefore the discounts have blown out incredibly wide, and we've been picking up these trusts at wide discounts. So to leave it on a more upbeat note, having started on a slightly down one, we think that the headwinds that have caused such dislocation in the market over the last 18 months will be moving into tailwinds. So inflation has remained stickier than most investors would have necessarily liked or expected. However, we do think that the pathway is still downwards. We do think there will be interest rate cuts maybe later in the year than anticipated, but they will come, and that should be beneficial for asset prices. We think actually the consolidation means that we have also seen some splintering from some of these bigger wealth managers into smaller outfits which are able to buy investment trusts, and that creates new buyers. We think that the extraordinary lobbying that the sector has done of the Treasury and the FCA on the OCF declarations should bear fruit, and we should see some movement on that, which would be enormously helpful for the sector. And so we're looking at this scenario in which trusts are moving out of this pretty hostile environment, and we're very excited about the future.